Welcome to Earnings Recap. Today we're covering Caterpillar's earnings report and earnings call January-March 2025. If you enjoy this kind of content, please like the video and subscribe to the channel.
Yeah, absolutely.
All right, let's dive straight into Caterpillar's first quarter 2025 performance. We've gone through the earnings report and the call so you don't have to, and well, we're here to pull out the crucial bits in plain English for you.
Exactly. And we'll kick things off by looking at the key financial figures from the report itself. Gives us a good snapshot of how CAT performed in those first 3 months.
Okay, so starting at the top, what were the top line numbers telling us? Sales and revenue.
Well, overall, Caterpillar sales and revenues for Q1 2025, they came in at $14.2 billion. Now, that's actually a 10% decrease compared to the same time last year, Q1 2024.
10% down. Okay, what was behind that drop?
It was mainly two things. Lower sales volume, just selling fewer machines, and also unfavorable price realization, getting less for what they sold. Currency movements, the stronger dollar, also had a bit of a negative impact too.
Right, the usual suspects sometimes. So, a bit of a step back in overall revenue then. But were there any parts of the business that held up better? Maybe some bright spots?
Yes, definitely. It wasn't all bad news. While the overall machine sales to users, so think construction industries and resource industries combined, those were down, but only by 1%. And actually, that was better than many people were expecting.
Okay, only 1% down for machines to users. That's interesting.
Yeah, and what's really standing out is their energy and transportation segment. That division saw a 13% increase in sales to users. Pretty significant.
13% up. Wow. What drove that?
It was largely powered by a real surge in their power generation business. We'll probably talk more about that later. But yeah, power gen was key.
Okay, that energy and transportation growth definitely stands out. Let's maybe dig a bit deeper into how each of the main segments performed on those sales to users metrics. How about construction industries?
Sure. So construction industries actually saw a 3% increase in sales to users year over year.
Oh, okay, up 3%.
Yeah. North America was slightly higher than the prior year. They mentioned residential construction offsetting slight declines in, non-residential stuff and maybe lower rental fleet loading.
Right.
EAME, so Europe, Africa, Middle East, that region increased, led mostly by Africa and the Middle East.
Yeah.
Asia Pacific, though, was down.
And Latin America?
Latin America continued to grow, and actually at a higher rate than they'd anticipated. Still strong there.
Okay. And resource industries, that's the mining and heavy equipment side. How did they fare?
Resource industries, their sales to users declined by 10%, but like with the overall machine number, this was actually better than expected.
So down, but not as much as feared.
Exactly. It seems they saw stronger mining activity, heavy construction held up okay, and quarry and aggregates too.
Yeah.
Plus, they mentioned getting some of those big off-highway trucks placed into service maybe a bit sooner than planned.
Got it. So some unexpected resilience there too. Now, back to energy and transportation, that impressive 13% growth. You said power generation was the main story.
Precisely. Sales to users in power generation grew by a huge 58%. 58%.
Wow, 58%. What's driving that kind of growth?
It's primarily demand for reciprocating engines, particularly for data center applications. That's the big one. Also some growth in turbines and related services.
Data centers, yeah, we hear that a lot.
Absolutely. On the other side of E&T, though, the oil and gas part, their reciprocating engines declined. That was due to softness in well servicing activity.
Okay.
And oil and gas turbines and services also dipped, partly because Q1 last year was a tough comparison, a really strong quarter, and they also had some delivery delays this Q1.
So a real mix within energy and transportation then.
Yeah, definitely. Transportation sales to users were up, though, and industrial sales grew slightly, but that was from a pretty low level already.
Okay, so the data center boom is really carrying that segment right now. What about dealer inventory? That often gives us a clue about underlying demand, right? How things are moving off the lots.
Good question. So total dealer inventory increased by about $100 million in the quarter. Now, what's really notable here is how that compares to last year. In Q1 2024, dealer inventory jumped by $1.4 billion.
Oh, big difference.
Huge difference. So this $100 million increase is way smaller. And actually, the inventory of machines, specifically held by dealers, was almost flat.
Almost flat. So machines aren't piling up at the dealerships.
Doesn't seem like it. Suggests products are moving through the channel relatively well. Healthy underlying demand, you could say.
Okay, that's a positive sign. And the other side of that coin, the forward-looking indicator, their order backlog, how's that looking?
The backlog tells a very positive story. It actually increased by $5 billion just since the end of last year.
$5 billion added in one quarter.
Yep. It reached a record high of $35 billion total.
Wow, $35 billion backlog. That's massive.
It really is.
Yeah.
And that strong order rate was seen across all three primary segments, but energy and transportation really led the charge there. It provides a pretty significant buffer, against potential future bumps in the road. Shows strong demand.
A record backlog is definitely a strong signal. Okay, let's pivot to profitability. How did Caterpillar actually perform on the bottom line? Margins, profit per share.
Well, their adjusted operating profit margin came in at 18.3%. That actually exceeded expectations.
Better margin than expected. Why was that?
They said it was mainly due to favorable manufacturing costs. They managed their factory costs well, it seems.
Okay.
However, the adjusted profit per share was $4.25. That's down quite a bit from $5.60 in the first quarter of last year. And overall operating profit decreased by 27% to $2.6 billion.
So margins better than expected, but overall profit dollars down significantly year over year because of that lower revenue.
Exactly. They're making more profit on each dollar of sales than anticipated, but the total pot of sales was smaller.
Right. How did that translate into cash flow, free cash flow?
Their main free cash flow measure, ME&T free cash flow, was $200 million for the quarter. That's a decrease from the previous year, and that's mainly just flowing down from the lower profit number.
Okay, lower cash flow generation. But what about returning cash to shareholders? Did that continue?
Oh, yeah. They deployed over $4 billion back to shareholders just in Q1. About $3.7 billion of that was share repurchases, including a big $3 billion accelerated share repurchase program they did.
$3.7 billion in buybacks.
About $700 million in dividends. And it's worth remembering, Caterpillar has now paid higher annual dividends for 31 consecutive years. They're still a dividend aristocrat.
31 years. That's consistency. Okay, before we move off the report numbers, any quick highlights on the financial performance of the segments themselves? Beyond just sales, profitability by segment.
Yeah, quickly. Construction industries. Sales down 19% to $5.2 billion. Profit down 42% to $1 billion. Margin was 19.8%, so profit fell faster than sales there. Resource industries. Sales down 10% to $2.9 billion. Profit down 18% to $599 million. Margin there was 20.8%. A bit more resilient on the profit side than construction.
Okay.
Energy and transportation.
Yeah.
Sales down only 2% to $6.6 billion. But their profit actually increased by 1% to $1.3 billion.
Yeah.
So their margin improved to 20%. That power gen strength really helping there.
Right, that margin expansion in E&T despite slightly lower sales is interesting.
Finally, financial products. Revenue's up 2% to just over $1 billion. But their profit decreased by 27% to $215 million.
Why the profit drop in finance?
Mainly because they didn't have a one-time insurance settlement gain this year that they did have last year. Also, slightly higher provisions for credit losses, setting aside a bit more for potential defaults.
Oh, okay. But customer health is okay.
Yeah, they actually stressed that customer financial health remains strong.
Yeah.
Past dues were apparently at their lowest first quarter levels since way back in 2006. So customers are generally paying their bills on time.
Okay, lowest past due since 2006. That's a good sign for the underlying customer base. Right, that gives us a really detailed picture of the Q1 financials from the report.
Yep.
Now, let's switch gears. Let's talk about the earnings call itself. The discussion with analysts, management commentary, the outlook. What were the key highlights there?
Okay, probably the biggest piece of news from the call itself was the CEO transition announcement.
Ah, right, the leadership change.
Exactly. Jim Umpleby announced he's stepping down as CEO effective May 1st, 2025. He'll become executive chairman. And Joe Creed is succeeding him as CEO. They said that this follows a multi-year succession planning process.
Joe Creed taking over, that's obviously significant. Markets always watch leadership changes closely.
Absolutely. A big development.
Okay, beyond the CEO news, what about their immediate outlook? What did they say about the second quarter, Q2 of this year?
For Q2, they're anticipating sales will be pretty similar to the second quarter of last year, so roughly flat year over year for Q2 sales.
Flat sales, how does that break down?
They expect the continued growth in energy and transportation. That power gen strength, again, will basically be offset by lower machine sales in both resource industries and construction industries. The main drag on machines, they said, would be unfavorable price. Volume, they expect, will be about flat overall for Q2.
Okay, flat volume, negative price on machines, offset by E&T growth. What about margins for Q2?
They are expecting lower enterprise-adjusted operating profit margins compared to Q2 last year. And that's excluding any new tariff impacts, again, driven mainly by that lower price realization they mentioned.
Right, tariffs. That's been a huge topic lately. Did they give any specifics on the tariff impact they're expecting?
They did. They addressed the tariffs announced and implemented this year specifically. They estimate those will be a cost headwind of somewhere between $250 million and $350 million just in the second quarter alone.
Wow, 250 to 350 million just in Q2. That's substantial.
It is. And they noted that figure is net of their initial sort of short-term mitigation efforts. They also stressed they're actively evaluating longer-term actions to try and lessen that blow further down the line.
Okay, a big near-term hit from tariffs.
Yeah.
How does all this, the Q2 outlook, the tariffs, how does it factor into their view for the full year 2025?
They gave a couple of scenarios, which is interesting. First, the sort of pre-tariff scenario. If you ignored the new tariffs, they said they expect full year 2025 sales and revenues to be about flat compared to 2024.
Okay, flat pre-tariff.
Yeah. And in that scenario, adjusted operating profit margins would be in the top half of their target range, and ME&T free cash flow also in the top half of its $5 billion to $10 billion target range. So pretty solid.
But that's without the tariffs. What's the scenario with them?
Right. So the second scenario factors in the current tariffs and also assumes maybe some negative economic growth for the second half of the year.
Yeah.
Even with those headwinds factored in, they expect full year 2025 sales and revenues to be down only slightly versus 2024. And importantly, they still expect their adjusted operating profit margin and their ME&T free cash flow to land within their target ranges for the full year.
So even with tariffs and maybe a weaker H2, they think they can stay within range for margin and cash flow.
That's the message. It suggests, a certain level of confidence in their ability to manage costs and maybe find offsets, even before considering further mitigation actions on the tariffs. Resilience seems to be the key word.
Okay, that's somewhat reassuring given the uncertainties. Did they give any more color on what they're seeing in their different end markets during the call? Maybe responding to analyst questions? Let's start with construction.
Yeah, they did. For construction industries, management sounded, encouraged, actually. They noted sales to users were better than expected, and order rates are strong. Customers seem to be responding well to the CAT financial programs they're offering.
What about specific regions for construction?
In North America, they see healthy construction spending, good infrastructure project awards happening. China is showing some, quote, positive momentum in the bigger excavator market, but it's coming off a very low base, so context is important there.
Right.
Asia Pacific outside of China is soft. Europe remains weak. Africa and the Middle East are providing some support. And for Latin America, they expect a moderate decline for the full year now.
Okay, a mixed bag geographically for construction. What about resource industries? Mining, heavy stuff. What was the commentary there?
They highlighted strong order rates again, and that growing backlog, especially for the really big mining trucks, rebuild activity, refurbishing old machines, is expected to stay healthy.
Are miners spending freely?
They said customers are showing capital discipline, so maybe not spending wildly. But product utilization is high, machines are being worked hard, and the average age of the fleets out there is getting pretty high.
Which usually means replacement demand has to come eventually.
Exactly. They also mentioned growing acceptance of their autonomous solutions, which is a key tech push for them.
Yeah.
And they think the whole energy transition story will ultimately support increased commodity demand long term.
Makes sense. Okay, and finally, energy and transportation on the call. Obviously, we know about power gen, but any other details?
Yeah, confirm the strong backlog growth in both oil and gas and power gen. Power gen demand, again, high for those recips, and solar turbines for data centers. They did reiterate the expectation for continued softness in oil and gas well servicing.
Okay.
But positive momentum in gas compression. Industrial applications expected to remain kind of low, while transportation is stable. And they did repeat that point about capacity for the large engines for data centers being full for 2025, and they're working hard to increase output. Lots of inquiry activity for turbines, too. It just really hammered home how critical that data center market is right now.
Definitely sounds like a major, major driver. Were analysts pushing hard on the tariff questions during the call, how Caterpillar plans to navigate that?
Oh, yeah, definitely. Several questions trying to dig into the tariff impact and mitigation plans.
Oh.
Management basically outlined a few approaches. Short-term cost cuts, looking at dual sourcing for parts to have alternatives.
Right, diversifying suppliers.
Yeah, actually, and longer-term supply chain adjustments. They also talked about pricing, saying they'll consider price increases, but it depends on the tariff amounts, market conditions, competitors, The main goal, they stressed, is growing operating profit after tax in dollar terms.
So protecting the bottom line dollars.
Right. They also expressed some, let's say, cautious optimism about potential future trade deals, maybe reducing the tariff burdens eventually, but that's obviously uncertain.
Yeah, trade deals are always uncertain. What about the dealers? What was the vibe from the dealer network, according to the call?
Management said feedback from dealers aligns pretty well with what CAT is seeing. So dealers are reporting cautious optimism, continued sales moving, orders still coming in. And importantly, they haven't seen widespread pre-buying, customers rushing to buy before potential price hikes.
No panic buying suggests maybe a more stable demand environment.
Seems that way, yeah.
Okay, one last key area, margins. With tariffs hitting in Q2, what's the longer-term view on profitability that they shared on the call? Can they defend those margins?
They acknowledge margins will likely be lower year over year in Q2 because of price and tariffs. But they really emphasize the company's diversification and especially the growing focus on services, which tend to have higher margins, should help dampen that cyclicality over time.
Services as a buffer.
Exactly. And support long-term margin performance within their target ranges. They even hinted that maybe the low end of their historical margin range isn't really representative anymore, given how the business has changed and become more resilient.
Interesting. Sort of resetting expectations upwards on resilience.
Kind of felt like that. And the incoming CEO, Joe Creed, he chimed in too, basically saying the plan is to stick with the current strategy. Focus on services growth, use their operating model for resource allocation, grow OPAT dollars, and push growth opportunities across all segments: power gen, mining, critical infrastructure. Technology and rental are also focus areas.
So continuity of strategy despite the leadership change and confidence in the model despite near-term headwinds.
That seemed to be the core message, yes. Navigating complexity but focused on the targets.
Okay, so let's try and wrap this up. To summarize our deep dive into Caterpillar's first quarter, well, they reported a decrease in overall sales, but actually managed better than expected profitability, mainly through cost control, it seems.
Right. They're navigating a pretty dynamic environment. Definitely some potential headwinds from tariffs coming up, especially in Q2.
But they seem confident in their full-year outlook, still expecting to land within their target ranges for profitability and cash flow. And that confidence seems backed by that record $35 billion order backlog and the diversity across their different markets.
Yeah. And don't forget the CEO transition is underway. But the message is clearly one of sticking to the existing growth strategy, particularly focusing on services and key growth areas like power generation.
Absolutely. That demand for power generation, especially linked to data centers, really does seem like a huge, significant growth driver for them right now.
Which brings us to a final thought for you, the listener, to maybe mull over. Given this huge global focus on data infrastructure, data centers, and all the ongoing shifts and uncertainties in international trade and tariffs, how might Caterpillar's big investments in power generation and their, adaptive approach to supply chain management position them for sustained growth in the coming years?
Yeah, and maybe what are the longer-term implications, if any, of this CEO transition for CAT's strategic direction as they navigate these trends? Something to think about.